Hey, what's going on, traders? Todd here. I want to do an update, one that my clients at Inside Edge and some of our subscribers, former subscribers, have said, Todd, I miss you. You don't do Elliott Wave anymore, so I can't really follow you. Well, one, it's heartbreaking because we're so much more than that. Two, it's not true. And three, maybe it's a little true, but we'll nuance that a little bit here, and I'll show you why I'm stepping away. I'm not going to leave you hanging. The answer to that, and I'll tell you right now, and I'll hopefully show you and give you a foundation of what I'm about to say. I think we're in a secular bull market within a third wave that carries us significantly higher from here. And you don't need to smother or overthink or crowd the count, and certainly step away from the doomsday crowd who are competing for your clicks, likes, attention, subscribes, business, trying to sell fear. I have a problem with that pretty consistently, but especially here, I think in the grips of a third wave. Today is December 10th when the Fed just cut rates. Was it a hawkish cut, dovish cut? Though they did enact another edition of QE, which is buying short-term treasury bills to pump liquidity back in the system as the market's at all-time highs. Maybe the Fed's done cutting, maybe not. Earnings were solid. We're heading into the seasonally strong December Santa Claus rally period. We have a pro-business administration in. Anything could happen. 26 is definitely going to be bumpy. It's never smooth, I think, with the current executive in the congressional situation the way it is. I think there's going to be, in the geopolitics, I think there's going to be a lot of bumps, but I think it's going to create volatility that may seem very scary for those unplanned, weak-handed, not planned traders and investors who don't really understand what potential pullbacks could do in the grand scheme of, what should happen when the pullbacks end and the longer term secular AI driven bull market resumes. They try to time every twist and turn, and the saying I like to use is they try to dance in between the raindrops, which you're going to get rained on a little bit, but again, I think it's worth getting wet in order to every now and then to participate in a longer term uptrend. All right, so I just want to show you our old life from trading analysis, okay? And just to kind of drive my point home here, this is the old members area of trading analysis, okay? And I ran this business. We launched in 2012. I shut it down in the summer of 25 to focus on the money management business, which is Inside Edge. Best thing I've ever done. I do miss a lot of the people that we worked with. Members, subscribers, many of whom have come over in our clients at Inside Edge Capital, and it's great. Okay, but this is the old trading analysis members area. And let me just make a quick point before I go into Elliott Wave and longer term charts and updates. I want to remind you that we used to also sell training courses, and we used to charge a couple $100 to $1,000 per training course. I've opened those up for free. Okay, so everything I've done in terms of training, you can have them. You just got to put your email in under courses, and you can have them. I just made them available for free. So we've got Fib, we've got Elliott Wave course, precision timing, options with Fib, motive wave training, winning options with Elliott Wave. Have at it. This course, Elliott Wave Mastery, it was like $1,500. I think we charged for it, and we just made it for free. Okay. All right, back to what I was trying to say. Where am I going? Oh yeah, so I'm gonna go into chart room. Maps, that was market analysis, portfolio suite. We're going to chart room, and I'm going to show you the charts where we left off with the longer term Elliott Wave counts on the indexes, okay? Now, I'm barely even using, I'll save it. Here's the S&P. Okay, the last time I updated the charts was over a year ago. Oh my Lord, November 18th, 2024. Okay, so let's start out with where the S&P was a year ago. where we are now. I'll lightly update where we are. And again, I'm going to just arrive at the point now and not leave you hostage. And listen, we're in the grips of a third wave and there's not much to do except continue to ride the bull trend. Don't get bucked, with the inevitable 5, 8, 12% pullbacks that are going to happen every 12, 18, 24 months, because I think the 10% pullbacks and 12% pullbacks are worth sitting through. We do our best at Inside Edge to take some of the heat off and sort of put some hedges in and, take some of the heat off the portfolio and bring in some lower beta, more value-oriented positions around those corrections. We do our best. Nobody's perfect. But the trend is still intact. All right, so here is the long-term S&P chart, okay? S&P, the index, I believe, started in 1948, 4850 or something like that. And as I mentioned, you're superimposing the Dow, which began, I think, in the late 1800s, just before the Industrial Revolution. Actually, let's take a look at that. This might actually be a little longer than I anticipated, but that's all right. Dow. I know I have data from the 1880s, Industrial Revolution, but that's okay. So let me go back to the S&P, and I'm superimposing the 1929 crash from the Dow, which S&P wasn't around. We rallied up into the, I think we rallied up ahead of World War II, from the 1942 lows, World War II there, and then the market rallies. Okay, so I think that is 1, 2 after the 29 crash, and I think all of this is wave 3. Okay, so wave 3, we will reach the end of wave 3. We will have to answer to wave 4. That is the equivalent of the 1-2 sell-off. Again, post-29 crash, initial move up, move back down. And I know this was a 50% correction. And again, let me go back to the Dow just to kind of circle that. So it was an 89% crash in 1929, rally up into 36, 37, ABC correction down into 1942, which was the start of World War II, and that was a 52% decline. Okay, so I believe all of this is wave 3. Okay, now, yeah, this is massive compared to, the rally in wave 1, but, in the inflationary area when we got off, Bretton Woods, we got off the gold standard, the expansion of monetary base, devaluing of the dollar, technological innovation, I think that throws the rules that you read about in the 1979 book by Robert Prechter, who is interpreting Elliott Wave that was put forth by R.N. Elliott and, the other practitioners who worked very closely with R.N. Elliott. Prechter picked it up, and I have a ton of respect for Prechter. I like all those guys a lot. I worked with them one-on-one, so I like him, but I just think that we're still in the grips of this significant long-term wave 3, okay? So that's, let's go back to the S&P story, which we pick up right about here. Okay, so 1, 2. So within blue 3, we will have to answer to blue 4. Blue 2, as I just said, was a 52% decline. And it was very sharp. Remember the ABC directional correction? Well, that means wave 4 is going to be sloppy and choppy. So I think a lot of people are calling for another stagflationary 70s, persistent inflation, slow growth. Yeah, I think that'll come, but I don't think until the 2030s or maybe even the 2040s. So years at 25, maybe 15 years from now, which again, wave 4 tends to be shallower in the percent retracement compared to wave 2. Wave 2 is 52%. So maybe we get a lost decade with, a lot of slop and chop sideways where the net change in the beginning of 3 compared to the end of 4 with all the chop and slop is maybe a 20, 30% decline after 5, 6, 8 years. I don't know. Nobody knows, okay? But within blue 3, I think we're doing green 1, green 2, green 3, green 4. Now, I think we have green 5 to come, which will cap off blue 3. And then we're due the equivalent size correction in wave 4 as the pre-World War II correction, okay? So, okay, good. Now, if we look inside of ABC, now this was the tech crash. That's the housing bubble precipitated by Greenspan cutting rates too quick. In Wall Street package up all the toxic housing debt, crashed the economy, almost lost the financial system. I think that was a big ABC. And then we go up in 1, down in 2. All right. So let's pick this up from the 2008 low with red 1, 2, red 3, red 4, red 5. Okay. So that was the S&P. Okay, so here's red 1, here's red 2. Now, coming off of 2009, I don't see any other way to count this except 5 up. 1, 2, 3, 4, 5. That's it. And then we had the largest correction in both price and time from 17, 18. We had the debt. We had the debt downgrade, Fed raise rates. No, that was back here. Fed raised rates a couple times. We rallied up. There was a nice tech Nasdaq-led rally here that ran smack dab into COVID. And I think that created an expanded flat. And then we did 1, 2 again. Okay, so I think what we're saying here is in blue 3, we're in the grips of this wave 3 of a higher degree third rally. And that's why I'm really not smothering the wave count, because we're in a third of a third. And it lines up with, okay, we got the Fed funds rate up to 3.5, 3.75. Inflation's running at 2%, 2.5%. So your real interest rate's 1.5%. Productivity is awesome. Earnings are great. You have a very pro-business government, love them or hate them, but that's just what it is in a deregulatory environment. And he's going to put someone in there in the Fed chair that is going to do his bidding. And now we have, Chair Powell, who's trying to cement his legacy with 6 to 9 months to go, whatever. Enacting QE, it's a pretty bullish situation right now. All right, so this is the monthly, blue 3, blue 4. Here's this. Okay, so here's blue 3, blue 4. All right, so here's where we can start to pick up the story. Guys, once I start getting into the weekly and daily, with these choppy indexes is where I really start to get nervous employing the Elliott Wave count. I'm like, here's where things get really choppy. And I've watched a lot of my beloved friends and colleagues who do professional Elliott Wave analysis, and it's been a pardon my language, shit show with the, I would say, daily bar and below Elliott Wave analysis with the index is just too choppy. Okay, so that's another reason I'm staying away. All right, so when I left, this was November 18th, 2024. I was looking for resistance in the S&P into like 64 to 6,800 before we got green 4. Let's look back a year later and see how we did. All right, so I just dusted off an old workspace here, and I'm not really any good at this anymore. And it's not the same count, so just keep that in mind. So you know what, let me go to a weekly. And the new Motive Wave, like, again, I love all the guys and girls at Motive Wave. They updated the software. I don't know how to use it anymore. It's so different. It just lost me. I used to be able to dance around with it very quickly. I can't really do it anymore. All right, so let's squish this up. And it's not me going to a Mac. I love being on a Mac now. All right, so we're looking at COVID-1 heading into 22, inflation, interest rate spike. We launched Inside Edge in October of 21 right here. Soon as we hit the money management business, we got smacked with 2022 sell-off. So that's wave 2. And then I was looking at a rally in the 64 to 6,800 sell-off in green 4 into the beginning of 24. Okay. How did we do? Well, yeah, that was a good call, actually. We did green 3, green 4, and now we're moving up in green 5. So I guess that's going to look like potentially, come here. Okay. I'll fill that in now. Let me also, option 3, 100% is there. Now, if this is a good wave 3, and this is why I started getting nervous on this count, a good wave 3 should go at least 100% of 3v1. Okay. Now, ideally, and the textbook is 1618 for wave 3 V1. So percent distance in COVID to 22, whatever that is, the equivalent is 100% 7675. The 1618 is a 12,000, the S&P. I mean, that's just a textbook wave 3. So, okay, when I left, I was like, all right, we're doing 1, 2, 3, a pullback in 4, then a move up to 8,000. Could that happen? Yeah, it could. And it would look like this. I think I did it. Oh, stop. Oh, it's still doing that. I remember a year ago when I stopped using it, it was doing that. 3, 4. And then where did 5 go? Where'd you go? Over there. Okay. All right. So the green is the labeling convention I was using back then. I don't know. It's not the same anymore. That's all right. So 3 into 64 into the end of 24, early 25, and then pull back to like 53, 54. We went well below 52, 53, 4. Okay. And then we're moving up in 5. Now, the first thing is like, okay, could the original analysis that we left here, could that be accurate? It could. It certainly could. If we start to fail, somewhere around here, okay, that's something I can entertain. And one checkpoint that we always did is you always got to make sure wave 3 is 5 smaller waves. Okay. I don't know. What do you do with that? I don't know. Chop, 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 chop. I don't know. Something like that, maybe. A, B, C, D. Yeah, whatever. I don't know. Okay. So, all right. First thing is I had 76.75. This is back in November of 24 as, a zone, and there's 76.75. So, we're at 68 and change right now. We have another, what's 675 plus 160, whatever it is, 770, whatever, 800 and something S&P points, which would be like another 12 or 14% rally. I used to know how to do this. Where's my, that's all right. I don't want to, whatever. 76, 75. Okay. So if by chance we don't hold that and push higher, that really calls into question my 5-wave count. And it only further echoes my point. If we don't hold this and start to sell off, okay, then I'll tell you the alternative, right? Now, let's say we go 76, 75 and we sell off in wave 4. Here's another example. Do we want to flip out and say, oh my God, get me out of all of my stocks, sell everything, I want to be hedged? I mean, if you do a 4v2, you're going to go from 76 down to 6,058. I mean, yeah, it's a 20, 30. God, I wish I could do how do I do a ruler? I wish I knew. Anyway, 76, 6,000, 1,600 points is a percent of 76. That's going to be a 20, 25% sell-off. I'm not going to sit idly by. Do we want to eject all of our stock positions and then risk missing the first 10% up day, which is going to do irreparable damage to your portfolio long term before you finally get in? By the time you get out here, watch the bottom happen, get back in, you're probably going to be about break even. And if you do that, you've wound up on a pretty good side of things. More times than not, by the time you sell about here. You watch the market rebound. You have denial because it's still you think it's a B wave rally. It's going to come off. By the time you get back in, it's here. So you end up selling here, buying here, and you're like, oh, good. At least I sidestepped the sell-off. Trust me, guys, I've seen it in so many different investing accounts. Like even for this potential immediate resistance in wave 4, I'm telling you, good luck selling here and buying back here. I've seen very few retail investors do it. Okay. If I'm wrong and we're not heading up into 5 or 3, selling off in 4, if we do break through 76, 75, you know what's going to happen? This big ass correction in Q1 of 2025 is wave 1, 2 again. All right. So what that means, and I'm going to further make my point with the Nasdaq, Don't forget, off of COVID to 2022 highs, the ideal 1.618 projection, which those are not my rules, that's classic Elliott Wave, is S&P 12,489. So with this the biggest correction that we've seen since the 2022 lows, which was Q1 of this year, that's probably 1 and 2 of 3. So are we in another third wave of a third wave of a third wave? Holy bananas. See what I'm saying? 3, 4, pull that up, connect that to 3. And I know the font sizes are off. Okay, so that would mean that we're in wave 3 of higher degree 3. Have a wave 4 sell-off. Again, what was this decline? Whatever, 48 to, that was a 20-something sell-off. Probably a shallow wave 4. Then we go up in 5 of 3, and then we're do a wave 4 correction that would square up against 18, 19, and 20 COVID with expanded flat, right? So we could be in 3 of 3 of 3. And this is part of the point. I'm going to go into the Nasdaq next. This is part of the point. I'm like, yeah, again, I find the daily charts and below very choppy with Elliott Wave. I still do it. I still know what's going on. We're either going to 7,600, which is another 12, 15% higher than sell off, or we're going a lot higher. I don't need to smother the wave count right now. Okay. I need to focus on holding strong stocks in our investors' portfolios and make as much money as I can for us, my parents, Kyle's family, Kyle's daughter, Kyle's wife, everyone who's invested in this, my neighbors, everyone's accounts who I have the honor and blessing to take care of. My job's to maximize return in those portfolios. So again, we're either going 12, 14% higher or 40% higher, I think. And if I'm wrong, we're going to deal with it. I'm not staking my reputation on this call. I'm just saying this is the proper application of Elliott Wave, and it's telling you don't smother the account. All right. So, longer term, that's what we could be looking at. Now, let's go over to the Nasdaq. Okay. Now the Nasdaq, how far into this video am I? 22 minutes. For me, that's not bad. All right. Nasdaq's tougher because it doesn't have as much history, right? The Nasdaq Composite started back in the 70s, I think. And then the Nasdaq 100, I think, started in like 88 or 89, I believe. All right. So the Nasdaq is tougher because of the tech sell-off in 2000 obviously hit the Nasdaq a lot harder than the S&P and the Dow. And then you had this weird wave 1 and weird wave 2 right here. Is this all of the correction in the 2000, or was this some kind of ABCX, ABC, and then a 5-wave C of flat down? Could this have been some kind of complex B and then a 5-wave move down and C? And then in fact, what that means is this 4 would go here. And then that would mean that this is all wave 5. This is the biggest correction we've seen since the GFC lows. That would mean this is 1, this is 2. And I mean, forget it. I don't even want to tell you the upside price projection on the NASDAQ if that's the count. I'm being more conservative in saying the correction was over here. The new 5-wave started here. 1, 2. This is 3. This is 4. And we're looking at it clustering either into 27,000 or 46 to 52,000. All right. So that's the monthly NASDAQ. Okay. So again, 26 to 42. Let's see what it looks like now 1 year later. All right. So when I left us, NASDAQ was at 18,788. Which was right 18th. Roach is right here. Is that right? No. 25. Oh, that was still 24. It was back here. Yeah. November of 24 was right here. Okay, right here. So I was looking for resistance into 24,570 or 20,071. We got to 20,022. So we actually didn't get to it. Big sell-off in Q1 of 25, and then we rallied. Okay, so the S&P was closer. My resistance was, beginning of the resistance zone was 20,071, which was here. So we missed it and then sold off. Okay, so the point here is and I had analysis in here. I believe I did. Decompose, impulse. Okay. The point here is if this more conservative wave count that I left for you a year ago is correct, it would have to be 1, 2, 3, 4, 5 of 5. Okay. So let me just take a second here. I'm a little out of practice with this. What would that mean? Okay. Let me scrunch this up a bit. Okay. What would that mean? First thing I want to know is in an extended wave 3, which this clearly is, distance traveled in the 1, which again, I want to stress, I have my serious doubts that that's a motive wave. I mean, I see that as 1, 2, 3, 4, 5 for A, some kind of choppy B, and then up in C. That does not look like a 5-wave move to me. Okay. Again, if I just hope you really understand what I'm saying if you're an Elliott Wave follower. Okay. But let's go with it. 1, 2. All right. The good news is if this conservative count is right, resistance is right here 100% at 26,350. And I think in my old, I think my old count, that was the same one, 26,043. There's going to be slightly different prices. The 6th one, it was at 18,342, 18,128. So that's the same one. Yeah, 5E1. So if this count is right, which I don't think so, because one of my biggest rules is you got to be able to count a 5-wave move inside of wave 3. You can't do it. That doesn't work. Sure, I guess so. You can't count 5 in there. It doesn't work. You have overlap between 2 and 4. Like, can't do it. Does not work. So that's not a 5-wave move, and this is a week, okay? But let's go with it. Again, if that's accurate, we face resistance right here at 26,350, which is right here. Okay, we're at 23,576, so another 3,000 points in the S&P, and how do we even do a rectangle? I don't even know anymore. Whatever, right here. We face resistance right here. Okay, and then if we start to sell off from here, okay, I will really pay attention to this. Okay, but I don't think that's going to be the case, just like with the S&P. And if I'm wrong and we don't fail right here, then there's probably something else going on, which goes back to this 2000, 2002 housing, 2007 GFC, and that's probably not the case. And in fact, the 5-wave move here remains, but what it means now is this is A, that's B, and this is C. Let me see if I can just put that on there for you quickly. ABC. No, correction. How do I put a correction up? Correction, ABC. It's probably A, B, C. Where did it go? Anyway, you know what I'm trying to do. And further, this 5-wave move remains. This is the largest correction that we've seen since the global financial crisis. That means the completed 5-wave move is here. This is 1, this is 2, and this is just a choppy one of a higher degree 3 that's going to come. All right, so what that means here is it would look like 1, 2, 3, 4, 5. Come here. Okay. Degree, let's go primary. Oh, come on. I used to be able to click right on the thing, on the scale, and it would scale up for me. Oh, Jesus. I can't even use it anymore. Anyway, let me just see if I can push this to the side. Okay. Holy bananas. Would you stop? All right, good. So I've just put the 1 and 2 off to the side. So this would have to be demoted because we have 1, 2. This would be, let me just make this a different color format to distinguish a bit. Okay, apply. Okay, good. Let me make this a different color properties format. Let's make it green. That's fine. Okay. So now what this means is if we don't hold resistance like 12% higher or so and sell off significantly, that means that we are in a higher degree. Oh, this is actually interesting. It would still be a sell-off, but it wouldn't be a very sharp sell-off because it would be wave 1 of 3, and we're getting a wave 2 sell-off of higher degree 3, which then sets up the wave 3 of 3. Right, so either way, probably 12% higher in terms of resistance, as I mentioned, sets up a wave 2 sell-off that gathers itself, and then we head into wave 3 of higher degree 3. Okay, that's the bullish situation if, again, that resistance zone that I mentioned did not hold. Okay, so again, when we left, we were at 18,788 right here. 18,000, and here you go, November 24 right here, sold off, and here we are at the highs. So, I think this is more likely. Are we going to get a more significant sell-off in wave 2? Or, as I said, the 5 of 5 and we sell off? Possibly. Or, guys, have we already seen 1 and 2? And the chop that I mentioned up here, maybe it's just a 5-wave move in wave 1, a choppy wave 1 getting started. And we've already seen, I guess it would be, yeah, 1, 2. Can that be a 5? That doesn't look like a 5. That's so bad. That's a 3-wave move in 3. That's fine. Let's go with it. We could already be in wave 3, right? So the point, I think, pulling it all together, like, we looked at the S&P, it looks clearly bullish. We looked at the Nasdaq, 12-14% above us is potentially wave 5 of 5. And okay, I'll be the first one to dust off, not the first one. I will dust off the Elliott Wave software and get better at it again and get up with a new update. But if we don't significantly sell off on a 12% move up, or it's kind of a wave 2 sort of feel on the way back, there's going to be a correction after another 12, 15, 18% higher. We have to judge the strength of that sell-off, and then determine at that time, look at the rotation, look at the macro, look at the sentiment, everything else that's going on, the politics, domestic and geopolitics, and figure out what's going on. But we'll assess from there. So more questions than answers, but that's just been my life with Elliott. And, so it's always a part of my arsenal. It's something I will always do, but am I going to lead on it and try to convince retail traders that you need to be doing it? And I want to charge you $500 to teach you how to do Elliott. When I was a young buck, a lot more energy, trying to save the world. Yeah, but no more. I want to run people. I want to run my money. I want to run people's money who understand that This is a very amazing mix of science and art, and there's no one way to do this, and you just got to kind of feel your way down through that dark hallway, bounce off the sides, but of the hallway, but keep moving forward. There is no answer to sidestepping volatility. It's inevitable, but I do think from everything that I even have seen here on the Elliott Wave charts, plus what I know, I'm using the other tools in the arsenal, that one, there's going to be bumps along the way. You can't dance in between the raindrops as you walking into the party. But you don't have to, because you're going to dry off and you're going to have a great time at the party if you can get to that finish line, which is why we named the business Inside Edge Capital. So, um, I hope that was helpful. Let me know what you think, and we'll leave it there. We're going to do our regular Thursday update for clients as well as public YouTube following the Fed tomorrow. So we'll see you then. All right, guys, have a good one. Thanks for listening. Take care.